Thanks for clicking! The federal government has announced even more mortgage rule changes, with a new insured refinancing program set to take effect in January.
Let's go win an election.
Well, yeah, probably. But unlike the previous measures coming down from the government, this one is actually set to put downward pressure on prices, as it allows current homeowners to take money out of their home fairly cheaply to build more secondary units. And this rule change comes on the heel of another rule change removing the stress test on uninsured switches, which came down from OSFI a few weeks ago, which, as we'll see later on, is bad news for Canada's banks.
I can catch a break.
So, if you're counting, we now have 4 big rule changes over the past month. 30-year amortization for insured mortgages, increasing the cap on insured mortgages from $1 million to $1.5 million, both of which targeted homeowners and were in general good for the real estate industry. And now we have insured refinancing and stress test-free mortgage switches, which, as we'll see, aren't that great for the industry, but definitely good for homeowners. So what I want to do today is go over these 2 new rule changes, take a look at how they're designed much more to help current homeowners rather than the real estate industry, and then go over some implications. As we've seen for the past month, the government does appear to be hitting us with a lot of loosening measures in short order, and we will obviously continue to track any more measures coming down from above on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these mortgages. On to insured refinancing. First, what exactly does it mean? Up until now, all refinancing was considered uninsurable, in that lenders were providing funds to borrowers without the protection of default insurance. Insurance which pays the lender in the event that borrowers don't make their payments. So, unlike when you buy a home with less than 20% down and you have to get CMHC default insurance, which pays the lender in the event that you don't pay, with uninsurable mortgages, any type of refinancing, that insurance does not exist, which means more risk for the lender and therefore a higher rate for the borrower. Until now, that is. Under the government's new rules set to take effect January of 2025, borrowers will now be able to take money out of their home and get default insurance on that loan, so long as those funds are used to build a secondary suite. In effect, this will allow borrowers to access up to 90% of their home's value and amortize that new loan up to 30 years. And for those looking to add an additional suite to their home, perhaps a rental or a suite for family members, these new rule changes offer several advantages. First, interest rate, in that you can usually get a much better interest rate on an insured mortgage than you can on one that is uninsurable. If we take a look at TD, a 5-year fixed insured rate right now is sitting at 4.49 compared to 4.74 for that conventional mortgage. As mentioned earlier, rates are lower for insured mortgages as it's less risk for the banks, as if you don't pay, the insurance will pay them whatever their losses may be.
The Iron Bank will have its due.
So, with an insured mortgage, payment should be at least a little bit better, though it's worth noting that we have not found out as of yet how much the default insurance will be on these new loans, on these insured refinances. Second, as mentioned, borrowers will now be able to access up to 90% of the projected value of their home, whereas under previous rules they would only be able to access up to 80%. So, if the home is currently worth $500,000 and the appraiser says that after you complete the project, after you add that secondary suite, the home will be worth $600,000, you can now access up to $540,000 and get insurance guaranteed by the government.
I need your help with something.
And yeah, well, that is the other side of the coin, as these new rules will allow homeowners to access even more debt, riskier debt at that, as they can go up to 90% of the projected value of their home, which obviously is a bit of a risk, as who exactly is projecting what that value of that home is going to be in 6-12 months when that home is completed. The real estate industry,
we're all fine, everyone's fine.
We're going to depend on the real estate industry to project home values. I'm in the industry and wouldn't trust it to project what happens when the sun goes away.
It's not coming back.
Regardless, no, Finance Minister Chrystia Freeland said that the program is intent on creating density. creating more homes for Canadians. With that said, how much demand is actually out there for something like this? A quick Google search of insured refinancing doesn't show anything really popping up prior to the announcement. So, is this going to bring a flood of new supply to the market in short order? Probably not, though it might help the construction industry, which has been showing some softening as of late. So, all in all, this will probably help, though it's unclear by how much. The government will be backing riskier loans, but at least those loans will be used to increase the housing supply, rather than the government backing refinancing to pay off delinquent boat loans.
Be my friend.
But the other bit of good news that we got, OSFI, Canada's banking regulator, is going to be allowing uninsured, non-stress tested mortgage switches at renewal, which, as we'll see, should help to correct some of the bank's loathsome behavior. And by their behavior, I mean the ridiculously high rates that they charge to their existing clients when they know that their clients don't have the option to switch their mortgage.
See, someone has leverage.
Prior to the rule change from OSFI, if you were coming up for renewal and you wanted to switch lenders, you would have to qualify at that new lender's rate plus 2%. You would have to qualify using the stress test. So, while you may have initially qualified at 4.79 or 5.25 for 5 years back, you would now have to qualify at 2 points above the contract rate, say 6.5%. Which meant if you were tight on ratios, you would have to stick with your current lender, who would offer you whatever rate they wanted. And even the Competition Bureau was lamenting this practice back in March, noting that the current lender faces almost no competition and can offer higher rates to those captive borrowers without fear of losing their business.
Now you can't leave.
And make no mistake, the banks were fully well aware of the power that they held. I'd get calls from multiple different borrowers from the same bank in the exact same week who were offered wildly different rates. But that's no longer going to be the case, as borrowers are now able to switch lenders and be exempt from the stress test, meaning they only have to qualify at the rate which they're going to be paying at that new lender. OSFI said, quite correctly, that this should lead to increased competition among lenders, which is a nice way of saying that the banks will no longer be allowed to engage in legalized extortion for the time being.
Don't say I never gave you nothing.
And further, unlike insured refinances, which as we saw before are riskier loans being backed by the government, this isn't really adding any more additional risk into the system. These loans already exist. These loans are already on the books of the banks, allowing people to switch, if anything, will reduce stress from the system. So, in summary, while the government had come down with those two initiatives, the 30-year amortization and the increased cap on insured mortgages, very much intent on helping the real estate industry, these two new measures are very much more intent on helping current home owners, allowing the addition of secondary suites, which should increase housing supply, though it's not clear by how much, but potentially adding additional rental income. And we have the news from OSFI, which should help reduce some of the anti-competitive behavior on the part of the banks, allowing for lower interest rates for current home owners. The extent to which these two measures will provide any observable aggregate changes in Canada's real estate market remains to be seen. But I think what is clear to all observers is that the election season is upon us, if we're not already in one, and the goodies are flying. Whether or not any more goodies are coming down the pike remains to be seen, but we will obviously continue to track any changes in Canada's mortgage and real estate market on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.